Welcome to How Rich People Really Invest in Stocks. Have you ever wondered what truly sets apart the investment strategies of the ultra-wealthy from the everyday investor? It's not just about having more money. It's about a fundamentally different approach to the market, one that prioritizes strategic thinking, long-term vision, and sophisticated tools. In this video, we're going to dive deep into the real investment secrets of the rich, debunking common myths and revealing the nuanced methods they employ to build and preserve their wealth. This isn't just about what stocks they buy. It's about how they buy them, why they buy them, and the entire ecosystem that supports their financial growth. If you're looking to elevate your understanding of investing beyond the basics and gain insights that could reshape your own financial future, then you're in the right place. Let's get started and uncover these powerful strategies together. Many people imagine that rich investors are constantly trading stocks, chasing quick gains, or only putting their money into well-known blue-chip companies. However, the reality is far more complex and disciplined. The wealthy don't typically engage in speculative day trading or follow market fads. Their strategies are rooted in long-term growth, diversification, and a deep understanding of economic cycles and emerging trends. They often think in terms of decades, not days or weeks, and their portfolios reflect this patient, strategic outlook. They also utilize advanced financial instruments and expert networks that are often inaccessible to the average investor. So let's peel back the layers and examine the fundamental differences that define their approach. One of the most significant differences in how rich people invest is their approach to diversification. For most, diversification means spreading investments across different industries or a mix of stocks and bonds within a standard brokerage account. But for the wealthy, diversification goes far beyond this traditional scope. They look to diversify across asset classes, geographies, and even types of investment vehicles that are generally not available to the public. This broad approach helps them hedge against market volatility and ensures that their wealth is not overly concentrated in any single area, providing a more robust and resilient portfolio against economic downturns. This isn't just about having more options. It's about having a wider array of different types of options. A cornerstone of wealthy investment strategies is the inclusion of alternative assets. These aren't your typical stocks and bonds. We're talking about private equity, hedge funds, venture capital, real estate, commodities, and even collectibles like art or rare wines. These assets often have a low correlation with traditional stock market performance, meaning they can provide stability and growth even when public markets are struggling. Private equity, for instance, allows them to invest directly in private companies, potentially yielding higher returns than publicly traded stocks, albeit with less liquidity. Hedge funds offer sophisticated strategies to manage risk and generate alpha. This embrace of alternatives is crucial for achieving superior, risk-adjusted returns that public markets alone often cannot provide. Another key aspect of diversification for the wealthy is looking beyond their home country. Geographic diversification involves investing in companies and assets across different regions and economies worldwide. This strategy taps into growth opportunities in emerging markets, hedges against economic slowdowns in specific countries, and takes advantage of currency fluctuations. For example, while the U.S. market might be strong, there could be significant growth potential in Asian tech companies or European luxury brands. This global perspective is vital for truly diversified portfolios, allowing them to capture growth wherever it occurs and reduce dependence on any single national economy. It's about seeing the world as their investment playground. Contrary to the myth of constant trading, the rich often excel at long-term strategic holding. Their investment philosophy is deeply rooted in the power of compounding returns. They identify high-quality assets with strong fundamentals and hold them for extended periods, allowing the gains to multiply over time. This approach avoids the pitfalls of short-term market noise and transaction costs. They aren't trying to time the market. They're betting on the enduring value and growth potential of their chosen investments. This patient discipline is a critical driver of wealth accumulation, as it allows even modest initial gains to grow exponentially over years and decades, turning small investments into significant fortunes. The wealthy understand that true financial success isn't a solo endeavor. They leverage extensive networks and rely heavily on expert advice. This isn't just about calling a financial advisor once a year. It's about having a dedicated team of professionals, including financial planners, tax specialists, estate attorneys, and investment bankers, all working in concert to manage and grow their assets. These experts provide sophisticated insights, identify exclusive opportunities, and navigate complex financial landscapes. This collective intelligence ensures that every investment decision is thoroughly vetted and aligned with their overarching financial goals, providing a significant edge over individual investors who often try to go it alone. At the heart of this expert network are financial advisors and, for the ultra-rich, family offices. A financial advisor provides personalized guidance on investment strategies, risk management, and portfolio construction. Family offices take this a step further, acting as a private wealth management firm for a single affluent family. They handle everything from investment management and philanthropic endeavors to tax planning and even lifestyle management. These sophisticated entities provide a holistic approach to wealth, ensuring that all aspects of the family's financial life are optimized for growth, preservation, and intergenerational transfer. It's a complete financial ecosystem designed to cater to their unique needs. Access to exclusive investment opportunities is another significant advantage for the wealthy. This often involves private placements, pre-IPO deals, or direct investments in promising startups that are not available to the general public. These opportunities typically come through their deep networks, established relationships with investment banks, venture capital firms, or other wealthy individuals. Being able to invest in companies at an early stage, before they become widely known, offers the potential for extraordinary returns. This insider access to high-growth, less liquid assets is a key differentiator in how the rich accumulate and expand their wealth, often leading to multi-bagger returns that public market investments rarely achieve. Tax-efficient investment strategies are paramount for the wealthy. It's not just about earning money. It's about keeping it. They employ sophisticated methods to minimize their tax burden, legally maximizing their net returns. This includes utilizing tax-advantaged accounts, understanding capital gains taxes, and strategically timing investments and withdrawals. They work closely with tax advisors to navigate complex tax codes and leverage every available deduction and credit. This meticulous attention to tax implications ensures that a larger portion of their investment gains remains in their pockets, further fueling their wealth accumulation, rather than being eroded by taxes. One common tool used by the rich for tax minimization and estate planning is the strategic use of trusts and foundations. These legal structures can help protect assets from creditors, ensure intergenerational wealth transfer, and significantly reduce estate and gift taxes. By placing assets into trusts, they can control how and when their wealth is distributed, often avoiding probate and minimizing taxes upon death. Foundations, particularly charitable ones, offer additional tax benefits while allowing them to engage in philanthropy. These sophisticated legal instruments are integral to preserving wealth across generations and optimizing tax outcomes, far beyond what simple individual accounts can achieve. Beyond trusts, wealthy investors also utilize strategic tax loss harvesting and charitable giving. Tax loss harvesting involves selling investments at a loss to offset capital gains and even a portion of ordinary income, thereby reducing their overall tax liability. This isn't about giving up on an investment. It's about timing the sale to capture a tax benefit while often reinvesting in a similar asset. Charitable giving is another powerful tool. By donating appreciated assets to charities, they can avoid capital gains taxes on those assets while also receiving a tax deduction for the donation. These strategies are expertly managed to optimize financial outcomes and align with their philanthropic goals. A compelling aspect of how rich people invest is their tendency to invest in what they know, a concept often referred to as thematic investing. They don't just blindly follow trends. They leverage their personal expertise, industry knowledge, and connections to identify promising sectors or companies. If they've built a successful business in tech, they're more likely to invest in tech startups or related industries. This deep understanding allows them to spot opportunities and assess risks that might be invisible to generalist investors. It's about combining their accumulated wisdom and networks with their investment capital, leading to more informed and often more successful investment decisions. This investing in what they know often translates into leveraging what some might call insider knowledge, though it's crucial to clarify this is legal and ethical insider knowledge derived from deep industry insights and extensive networks, not illegal information. They might invest in companies or industries where they have a unique understanding of market dynamics, competitive landscapes, or technological shifts. This could come from their own professional experience, their board memberships, or their connections with other industry leaders. This specialized insight allows them to identify undervalued companies or disruptive technologies long before the general market recognizes their potential, giving them a significant advantage in making prescient investment choices. Building on thematic investing, wealthy investors keenly focus on long-term trends and disruptive technologies. They are not chasing the latest fad, but are instead looking for fundamental shifts in society, economy, and technology that will create lasting value. This includes areas like artificial intelligence, renewable energy, biotechnology, and sustainable solutions. They invest in companies that are at the forefront of these transformations, understanding that these innovations will reshape industries and generate substantial returns over decades. Their patient capital allows them to ride out early volatilities and capture the massive growth potential of these groundbreaking advancements, often becoming early backers of the next big thing. While the wealthy certainly seek growth, a paramount concern for them is risk management and capital preservation. They understand that losing a significant portion of their capital can be far more damaging than missing out on a high-growth opportunity. Therefore, their investment strategies are meticulously designed to protect their existing wealth first and foremost. This doesn't mean they avoid risk entirely, but rather that they take calculated risks with robust downside protection, ensuring that even if an investment doesn't pan out, their overall financial stability remains intact. This conservative backbone underpins even their most aggressive growth strategies. For the rich, the priority is often preserving capital over aggressive growth. They understand that while growth is good, avoiding large losses is even better for long-term wealth accumulation. A 50% loss requires a 100% gain just to break even, a lesson they take to heart. They tend to favor strategies that limit potential downside, even if it means slightly lower upside. This careful approach to risk includes setting clear risk tolerances, diversifying extensively, and avoiding highly speculative investments that could jeopardize their core wealth. Their focus is on building a stable, resilient foundation that can withstand market turbulence and ensure their wealth endures. To further protect their capital, wealthy investors frequently employ sophisticated hedging strategies and other forms of downside protection. This involves using financial instruments like options, futures, or even short selling to offset potential losses in their long positions. For example, they might buy put options on a stock they own to protect against a sharp decline in its price. They might also invest in uncorrelated assets that tend to perform well when others struggle, like certain commodities or specific alternative investments. These advanced techniques are designed to cushion their portfolios against market downturns, ensuring their wealth is insulated from the worst of market volatility. So what have we learned about how rich people truly invest in stocks? It's clear that their strategies are far more nuanced and comprehensive than often portrayed. They don't just pick stocks. They cultivate a sophisticated ecosystem of diversified assets, expert advice, long-term vision, and tax-efficient planning. This approach allows them to consistently build and preserve wealth, navigating market complexities with a distinct advantage. While not all these strategies are accessible to everyone, understanding their principles can profoundly impact your own investment journey. It's about adopting a mindset of strategic patience, continuous learning, and intelligent risk management. To recap, the key differences lie in their extensive diversification into alternative and global assets, their unwavering commitment to long-term compounding, their reliance on a network of top-tier financial experts, their access to exclusive opportunities, and their meticulous focus on tax efficiency and capital preservation. They think holistically about their entire financial picture, rather than just individual stock picks. This strategic, almost architectural approach to wealth management is what truly sets them apart and enables them to consistently grow their fortunes across generations. For aspiring investors, the actionable takeaways are clear. Diversify beyond traditional stocks and bonds where possible, cultivate a long-term mindset, seek professional financial guidance as your wealth grows, understand tax implications, and prioritize capital preservation. While you may not have access to every tool of the ultra-wealthy, you can certainly adopt their strategic principles. Start by educating yourself, building a robust financial plan, and thinking beyond immediate gains. By integrating these lessons, you can begin to invest not just like the rich, but like the financially intelligent. Thank you for watching, and may your investment journey be prosperous.